right, perfect. So we are here with the Multifamily Investor Nation, really excited to share with you about how to make money as an apartment syndicator. And so we're going to go through a lot of these different questions here. What fees are charged, or can an apartment syndicator charge? What types of equity splits do apartment syndicators charge? What does a typical syndicator need to invest or does the syndicator need to invest their own money? And then, of course, even though there may be fees that you can charge, we're going to talk about the fees that you should charge, or what I believe you should charge, to get your investors to continue to want to still invest with you time and time again. And to share with you just a little bit about why I'm up here, I guess up here or in front of you speaking about this. Not only do I have experience teaching from the Multifamily Investor Nation webinar series that we do, also being able to be on stages. I'm in the trenches just like you, doing this every single day. And we started our group in 2018, and in 2018 we ended up raising about $4 million. This is with our group, PassiveInvesting.com. So you can see here, I'm one of the two managing partners of our group called PassiveInvesting.com. You have myself and also Danny Randazzo. And then, of course, if you'd like, you can also go to our page at the top. You can click on Meet the Team, and you can see the rest of our phenomenal team that we have that's behind us and supporting us in these various endeavors to be able to acquire the assets and the different asset classes that we have. We definitely have continued to grow, and we currently have a little over 50 full-time people that are working directly with PassiveInvesting.com and our ancillary businesses. Now, that doesn't include some of the full-time people that are working in the car wash operational side. There's probably another 240 or 50 people that are actually working in that operation. So it's a pretty big operation that we're running there. But with PassiveInvesting.com, I'm of course, one of those two managing partners. If you want to find out more information about them, you can go to PassiveInvesting.com, click on Meet the Team, and just click on my picture here, and you'll get some information about my bio. You also get a link over to my LinkedIn page, and then of course, here's a video about me and my background and kind of where we are today, if you will. So you can certainly do that. I do live and work here in Columbia, South Carolina, as you can see there. With my wife and I have 4 children, 3 girls and a boy, ages 12, 11, 6, and 5. And so if you're ever down here into the Columbia, South Carolina area, feel free to reach out. Love to be able to connect with you and meet up. The last thing I wanted to mention is about this event coming up next week, actually, June 12th to the 14th. It's going to be in Charlotte, North Carolina. It's called the MFINCon, the Multifamily Investor Nation Convention. And it's going to be in Charlotte Monday, Tuesday, and Wednesday of next week. We have some really great high-level speakers, Dr. Robert Cialdini, author of the book Influence, The Art of Persuasion, Mark King, the current sitting CEO of Taco Bell, and then Joe Fairless, who has $2.7 billion in assets under management with a group called Ashcroft Capital. And then, of course, if you go to the website here, you can see kind of where it's going to be located at the West End downtown, and then the times for the event should be over by 1:30 on Wednesday. And of course, some of the additional things that we're doing this year for the event, doing an alternative asset class breakout session with not just multifamily, but car wash, single family, hotel, self-storage, land, medical office buildings, all of those. And also that you can see here the 60, 70 plus speakers that we're going to have at this event as well. So would love to have you at this event. We really appreciate you coming there. You can go to mfincon.com to register for this event, and we look forward to seeing you there. All right. So let's dive into this topic here, which is around how to make money as an apartment syndicator. So let's ask the question here: how do you make money as an apartment syndicator? So what are some of these things that we need to go over here? So as most of you know, when I do webinars, I don't have a PowerPoint presentation or anything like that. So we're just going to go through this list question by question here. And if you have questions, I do have my Q&A box set up. So if you do have some questions, you can certainly type them into the Q&A box, and I will be reviewing them and answering those questions throughout the time today. So my plan today is to be done in probably the next 15, 20 minutes. We'll be done around 11:30, 11:35 a.m. Eastern Standard Time. So thank you for being with us, and make sure that you go over to mfincon.com and register for the event coming up. And I'll go ahead and type that link back in there again for you so you have it. Let's see. All right, so how to make money. Okay, what fees do apartment syndicators charge? So I'm going to go through the list of fees that are typically charged. so that you kind of have an understanding and kind of an idea as to where these different pieces are. So the number one charge or number one fee that I see getting charged on pretty much all the syndications is an acquisition fee. Now, when we talk about these fees, you have to understand like how they're actually calculated. Like, what's the number based off of? So for an acquisition fee, it's typically based off of one of two things. You can either charge it off of the actual purchase price of the asset, which is a very simple calculation. So if you're charging a 2% acquisition fee and you have a $10 million building, it's going to be very simple for you to be able to calculate that, because you can just take that $10 million building that you're buying, multiply it by 0.02, which is 2%, and you're going to get that $200,000 acquisition fee. Now, there's another way to calculate this, and instead of it being charged off of the purchase price, you can have it based off of whatever you want, as long as you're disclosing that to investors. And so what we typically do is we have it being based off of what is called the total transaction costs. So the total transaction cost is going to be the purchase price, the closing costs, and any CapEx expenses that are involved with it as well. So pretty much all the extra money that's going to have to raise as well. So let's say it ends up being, say, 11 million instead of 10 million. Now you take that 11 million, multiply it by the 2%, and it's $220,000 for that 2% acquisition fee based off of the total transaction value or costs instead of just the purchase price. So make sure that when you're looking at these different fees, you kind of understand that, even from your perspective as a passive investor and understanding how an operator is calculating it. But also for those of you who want to be operators and you want to put these things together yourself, you need to make a decision as to what you're going to base those fees off of. So the acquisition fee is the number one fee that we typically see, and that is typically going to be in the range of 1 to 3%, somewhere around in there. When we first got started, we started off a little bit lower, around 1.5%, and then we started increasing it. I think right now we're around 2 to 2.5%, depending on the type of asset that we're buying. If it's a little bit of an easier asset to be able to take down, then it might be a little bit less. If it's a little bit more challenging, of course, we would want to be compensated a little bit more for that, and so we might increase that just a little bit. But usually it's between that 1 to 3% mark for the acquisition fee. Now, the other fee upon closing, on the initial closing or acquisition of the asset, another fee that you can charge is what's called a loan guarantor fee. So if you have the financial net worth and the financial liquidity to be able to sign on your loans as the loan guarantor, then you can charge a loan guarantor fee for your efforts in providing that balance sheet to be able to sign on these various loans. And so, and that usually ranges from anywhere from, same thing, I'd probably say about quarter point to 50 basis points upwards to, say, 2 to 3%, somewhere around in there. I think right now ours is probably around that 1.5 to 2% range as far as the guarantor piece. Now, if you have somebody that's coming in, you can offer that to them as well. So let's just say you don't particularly have that net worth and liquidity, something that can attract these other syndicators, these other loan guarantors to come into your group and use their balance sheet to be able to acquire these assets as your sponsor and to sign on the loans. Of course, you can give them a kicker on top of the acquisition fee and the GP interest of giving them some additional spread from a loan guarantor piece as well. So the two fees we've talked about so far is the acquisition fee and the guarantor fee. Now, the guarantor fee, one thing that you have to understand there too is that it also is based off of either the purchase price. Actually, it could be three: either the purchase price, the loan, the balance of the loan, or the total transaction cost. And again, as long as you're disclosing it with investors on what you're basing that off of, you can choose whatever you want to invest it off of, right? And so that would be the three different areas that you can typically charge that guarantor piece to. The other, more commonly, let's actually talk about a couple of not so common fees. So you can also charge a brokerage fee. So I know some groups that have their own brokerage firm, and so they're brokering the deal from a sale perspective, whether they've contacted the owner, they've connected the operations or whatever, and they can charge a brokerage fee on top of what they've already been charging for the acquisition from the buy and sell side. And you can also charge what is called a CPA fee, if you will. So if you're a CPA and you're managing all the books, there are some groups that charge an accounting fee, is what they would call it. And so those are some additional ones that you could charge. I do also know that some people charge a a construction fee. So if we're doing a new development project, then we're typically charging a 10 to 15% fee for that. But if we are not, and we're basically just doing some CapEx, usually it's our property management company and our asset management team that's managing that. And because we're already getting a fee off of our asset management side of things, which we have not discussed yet, we don't typically charge an asset management fee and a construction fee or a CapEx fee. But I do know other groups that do, and that is perfectly fine. You can certainly do that. The biggest thing with these fees is you have to be careful not to fee the deal to death. So you can have deals that die because you just loaded up with too many fees. And if you fee a deal too much, then that deal can likely die because you can't afford to pay for it for what you need to be able to raise money and be able to provide a return for your investors. So the more fees you charge, the lower the return overall for your investors. And so it has to be a happy balance between, a healthy amount of fees, but also a healthy amount of return for your investors, because if you want your investors to come in time and time again, which is that last topic we're going to talk about, you want to make sure that you're not overcharging for some of these fees. So as far as the fees for like a CPA fee or a brokerage fee, the CPA fee I've seen usually between about a quarter point upwards to a point, and then that's usually based off of the total equity under management, and then the other fee, which is the CapEx fee, of course, will be charged based on the amount of CapEx that is completed. So if you're doing $1 million in CapEx and you're charging 5%, of course, that would be $50,000. And usually that's drawn upon as invoices from vendors are being paid off. You paid off the vendor, you take 5% and turn it over to you as the operator for managing that piece of the construction. So there's a lot of different ways to structure from that perspective. And then one of your other more commonly known fees, there's two extra fees I'm going to discuss. One is the asset management fee. The asset management fee is paid to you as the asset manager, as the operator, to be able to manage the day-to-day operations of the asset. Now, typically what's happening is there's three fees I want to talk about. So you have the asset management fee, which typically ranges from 1 to 3%, and then it's usually based off of one of two things. It's usually based off of the equity under management. So if you're buying a $10 million deal and you had to raise $2.5 million in equity, and then of course you could base it off that $2.5 million in equity that you had to raise. Now the third thing that you can base it off of is the overall income off of the asset. So as income is being generated off the asset, you can get a percentage of that income paid back to you in what's called an asset management fee. When we first got started with our group at PassiveInvesting.com, we started doing an asset management fee that was based off of the overall income. It was paid out on a monthly basis. Now we have pivoted and we have a little bit lower fee, but it's a fee that is based off of the equity under management on the actual deal itself. And again, that's still annualized and paid out on a monthly basis. And our asset management fee is what goes to pay for our team members. So those 50 full-time people that I'm talking about, that asset management fee goes to pay for those people, so that we as the operator don't have to continue to put more money into our main group to be able to keep it going. So up to this point, that asset management fee has grown as well as our team has grown. We've been able to grow our team as well as our asset management fee income as we've continued to grow and acquire assets. The other fee is the property management fee, right? So if you're vertically integrated and you're doing your own property management, then by all means, you can take that fee for yourself. For a multifamily, for us, we actually have a third-party group that we use called FCA Management Partners, and they are based out of Charlotte, North Carolina. And so they're the ones that are going to be getting that asset management fee. Asset management fee is going to typically be between that kind of 2.5 on the low end, upwards to 10 to 15%, depending on the size of the asset. So the larger the asset, the more units you have, the more on-site management that you have, the lower the fee is going to be. But if you don't have on-site management, you have say 20 or 30 units, and there's more hands-on that they have to do to send somebody there, then that fee can get up to say 10 to 12% is what I've usually seen it. I have seen it as high as 15 to 20%, but typically it's between that kind of 2.5 to 5% range if you're buying larger assets. And the property management fee is always based off of the gross income that the property management company has collected from the prior months, and they're paid out on a monthly basis as well. All right, so I do have one quick question here from Michael. Clarification on the assets under management fee is based on equity only and not on overall value of the assets. Yes, so I've actually seen it charged both ways, Michael. So I do actually know of a group that charges their asset management fee based on the overall value of the assets and not just the overall equity. So you could do it either way. Our group right now does it off of the overall equity in the deal. So if we're raising, like I said, if we're raising, $2.5 million to acquire a $10 million property, that's going to be $2.5 million of equity under management. And if our asset management fee is say 2%, then we're going to get $50,000 for that year, divided by 12, so 4,166 that we're going to get as far as that asset management fee as it's continuing to move forward. So hopefully that gave you a little bit of clarification there. Next thing here is what types of equity splits, we're going on to this second question here, what types of equity splits do apartment syndicators charge? So apartment syndicators are typically going to be in really one of two, maybe three different levels. So typically what you're going to see is you're going to see a preferred return, and we do what's called a true preferred return. So we don't do any pari passu or we're going back and catching up the GP or anything like that. It's a straight 100% of the cash flows goes to you as the investor until we reach that preferred return. Multifamily, the preferred returns are usually around 7%. If we have a separate preferred equity slice or tranche, like we do in some of our dual tier equity structures, then we may have two different classes of shares where one class of share will get a higher preferred return, but then no participation in the upside. And then we might have another share class that, of course, gets participation in the upside but has a little bit lower preferred return. So I'm not going into all the different nuances around the different equity splits and structures. We do have some other videos on our YouTube channel where we have done that. So feel free to go to the Multifamily Investor Nation YouTube channel and search in our channel for, hurdles or equity splits or things like that, or waterfall. And you'll be able to see some videos where I go into pretty deep detail into some of the different waterfalls that we have. But typically what you'll see that preferred return that'll come in up front. And then you'll also see an equity split above the preferred return. So in our group, we typically do a 70-30 split. I know some groups will do a 75-25, 80-20. I have seen it as low as 90-10 or 95-5. Typically, that's when you're working with an institutional group and they're going to cut your splits down a little bit too much. But typically, when it comes to apartment syndication, we typically see that between that 70-30 split to maybe 80-20 split is typically the sweet spot there. And you can adjust preferred returns up and down based on those splits. So, for example, we have an express car wash offering where we're acquiring a large portfolio of express car washes. Just started acquiring them last year. We have a preferred return on those of 10% because the cash flows are much higher, the returns are much higher, and the potentials are 20-25% plus return on our initial underwriting for the projections on those car washes. Much better than anything we're seeing right now with multifamily or self-storage or hotels, just because of the nature of the car wash business and the amount of cash flows that are generated from that business. And so with the car wash side of things, we have a different kind of equity split where we have a 10% preferred return. Because we are giving a higher preferred return up front, we are changing the splits where it's a 60-40 split after the 10% preferred return up to a 20% IRR, and then it splits the other way around, 40-60. Or 40% to the LP, 60% to us to the GP. And then even though our projections are not showing that we're going to get over a 30% return, there's a high probability that we will get over a 30% return for our investors. And so once we reach that 30% return hurdle, then the equity splits change again. They go 10-90. So we are highly incentivized as the operation group to way over deliver on the returns and get that 30% plus GP spread as we continue to exit the portfolio. Right now, we just started acquiring car washes in March of last year, acquired our first 2 assets. And right now, in the next probably 30 days, after we acquire a few more locations, we'll be at 28 locations from as high north as Maryland down to as far south as Fort Myers and as far west as Huntsville, Alabama. So we have assets that are kind of spread out here in the southeast, if you will, and are performing very well. So anyway, I just wanted to share with you that the equity splits there are some standard ones for multifamily, but there are ways to slice this up a little bit differently depending on whether you give higher or lower preferred returns. So the next question here is does the syndicator need to invest their own money? So the question is, they don't need to invest their own money, but I would highly encourage this syndicator to invest their own money, because that's how you can align your interest with your investors. Your investors want to see that you are investing in an asset that you believe in and you're confident in. And they also want to know that you have money at risk, not just, your promote, if you will. And so when we talk about, the investing your own money, I like to see 10% of the overall raise being put in by the syndicator. And if that's not possible, because maybe you're a new syndicator or it's too big of a raise, then I would say a minimum of $100,000 being invested alongside the investors in the investment. And I always say it's okay if you use part of the asset management fee, or the acquisition fee or the guarantor fee to do that, because at the end of the day, you're either going to take that money out and put it in your pocket, or you're going to still reinvest it and put it in a deal. So even if you're just using that money that you've earned for that acquisition to reinvest it, that's still your money, that your cash, that when you sell, you will get it. And so you are still investing alongside your investors. What I don't like seeing is an investor who takes on a $200,000 acquisition fee, and it puts zero money alongside the investors in their own project. I think that's a big red flag. And actually, in my red flags for passive real estate investing, one of them is making sure that the syndicator and the operator that you're investing with is also investing alongside you. And so you need to ask those questions and make sure that they are actually investing alongside you, and make sure that it's significant enough. I say at least 100,000, but preferably, around that 10% of the equity stack will be my preference, if you will. All right, so I'll get off my high horse around syndicators investing in their own money. And then my last thing that I wanted to touch on is this last section here, and which fee should you charge to keep your investors investing with you time and time again? So I'm going to answer this question, and I'll open it up for a few questions and answers that have come in, and I'll probably answer another 3 or 4 minutes with the questions. All right, so I'm going to share with you what fees we charge, and as you can tell from our track record, we have done a pretty good job. I don't know if I actually finished that, but we started in 2018, raised $4 million in 2018. In 2019, we ended up raising $32 million. 2020, we went up to $61 million, and that was in the middle of COVID. And then in 2021, we ended up raising $196 million. And then last year in 2022, we ended up raising $294 million. So right now we're sitting at just over $500 million in equity that we have raised. I think right now it's over $600 million now that we have raised since 2018 directly from our investors. We have over 2,000 investors. Our repeat investor rate is 72 to 73%, which means every deal that we put together, 72 to 73% of those investors in that project have already invested in a prior offering. So we're always getting new investors in, but we're also capitalizing on the fact that we're taking care of our investors that are already in our projects. We have over 2,000 investors that are active in our projects, and they are continuing to invest repeatedly in our projects. So in order to do that, you have to make sure that you're not overcharging, right? So we have two fees that we charge up front. We're talking about the acquisition fee and the guarantor fee. Those are the 2 fees they have paid up front. One fee that I did not mention was the disposition fee. The disposition fee is the fee that you charge when you sell, when you exit the property. And so that disposition fee is usually 1 to 3%, and it's based off of the exit sale price when you go to sell the property. Now, we do something very unique where we don't actually take that fee unless we hit a certain hurdle. Usually that ranges between about 12 to 13%, upwards to maybe 20% before we actually get that disposition fee. Because we also want to make sure that investors are getting a certain level of return before we start taking some additional fees for ourselves. So we have minimum hurdles there before we start taking in some of those fees, which helps those investors, feel like there's a better alignment of interest, if you will. So the disposition fee we charge would only have to be hit a certain hurdle, and then the only other fee that we charge is the asset management fee. Now, we do have a property management fee, but we don't take that from multifamily. That goes to FCA Management Partners, who manages the assets for us. So there's really 4 main fees. There is the acquisition fee and the guarantor fee that's paid upon closing of the initial asset. There's the asset management fee that gets paid along the way. And then there's also a disposition fee when we sell. So we have 4 primary fees. And then we also have, of course, our equity splits. Now, with our equity splits, we choose not to take any of our cash flow equity splits during the hold period. So we want to make sure that the deal has plenty of operating reserves, so we're not siphoning off cash from the investment during the hold period. It stays in there as additional operating reserves, and then we make ourselves whole on the back end when we sell the asset, and give us and provide us with those extra promotes, if you will. So anyway, I'm going to open up for questions and answers. Thank each one of you for being here. Don't forget to go to MFINCon and register for the event coming up next week. It's really exciting. And for those of you who are on here live, I did drop a promo code into the chat box there for you to go ahead and do that. It will be active through about 5 minutes after we're done with the webinar today. So if you have not done it yet, go register and make sure that you look me up so we can shake hands and put a face to the name. I always look forward to shaking the hands and putting a face to the name of some of our different audience members, if you will, that are throughout the country and around the world. So looking forward to having you there. So let me go through some of these questions that are coming in. All right, one of the questions is around how much do you think whatever the market conditions are affect what fees and amounts you or other GPs charge? I think, Richard, that it can have an effect on it because right now it's harder and harder to make deals work and make sense. So if you need to adjust some of your fees, you may have to do that in order to make some of these deals make sense. So you have to be careful there. The other thing you have to be careful of is changing your fees too much, where investors are kind of confused and wondering why you're changing your fees so much. So it might be good to be able to preempt some of those by answering those questions for your investors. Let's see. Andrew's asking, as a new investor in syndications, where do you start to determine where you want to invest, how to get in, et cetera? So that's a great topic, Andrea, and I know we've done a webinar specific on that. What I would suggest that you do is go to our YouTube channel and type in how to get started in multifamily. We also have a new book that is coming out that'll be teaching you about all the different things that we do here at PassiveInvesting.com and what we've been teaching on these webinars over the last 4 years, I guess, that we've been doing these weekly webinars and teaching you about the different nuances around multifamily and syndications. So hopefully that book will be out. I'm thinking it'll probably be end of June, first part of July. I know there's been some delays with the publisher, so it may be into the latter part of July, but we'll be sending out an email about that as well, and that'll give you some good feedback and information on exactly how to run an effective business. All right, Christopher's asking, thanks for hosting this call. What is your average return on your car washes? So our goal is to target between about a 22 to 24%, annualized return, if you will, on those. We do have, exit scenarios that get it up to say 27, 28%, and the cash on cash is usually between about 9 to 12% during the hold period. So there's a lot of opportunity there. If you want to find more information about that, let me just go to the website real quick while I'm on here with you. At the top of if you just go to PassiveInvesting.com, and then the top right-hand corner, you can go to current offerings. And if you click on Pit Car Wash 6, you can find some more information around this. This particular portfolio, which is called Pit Car Wash 6, is an 8-property portfolio with locations in South Carolina and Alabama. And so you can find out more information there. You can also put your information in if you want to see the offer memorandum and find out more information there. So a good question for you in regards to that. All right, let me go ahead and go to the next question here. What is your recommended, this is from Pablo, what is your recommended split in fees on a first-time syndication with $100,000 money from me and a partner? What do you suggest? I suggest doing whatever splits and fees make sense. So I wouldn't suggest trying to go in low and then increasing it over time. If I was doing it for the first time, I would do a straight, depending on the size of the asset, right? If it's a smaller asset, I might do like a 3% acquisition fee and then a 2% guarantor fee, and then put $100,000 co-investment from the partners, and then do a 2% asset management fee based on the equity under management, and then do a disposition fee based on the equity, based on the waterfall hurdles on exit, and you're hitting certain performance metrics. So, I mean, it's not very complicated. I think sometimes we think that when we first get started, we can lower our fees to kind of get in, but that's not how investors think. It's not. I've never looked at a deal and went, "Oh, this is a newer operator. They shouldn't get as big or they shouldn't get as good splits, or they shouldn't get the same fees." I mean, the fees should be very similar. Now, hopefully, if it's your first time syndication, you've maybe done some partnering with one or two other groups to kind of get your feet wet, build your track record, and build your credibility, and that can help you from that perspective. All right, let me just make sure I don't have something else coming up here because I know I have a little bit of a busy day. All right, so I'm actually good. I'll finish these 3 questions that are in here, and then we'll go ahead and wrap it up for the day. All right, how and how often do you communicate with your LPs? We communicate on a monthly basis to all the investors that are invested inside of our assets, and we do that via email. We do also have a monthly email report that goes out to all investors, even those who have not invested with us. We also have a printed physical newsletter that we actually print up and mail to our investors as well. And I'll be talking about a lot of this at our event coming up in Charlotte next week. I have a couple of sessions. I've purposely given myself multiple sessions to provide a lot of different feedback and information, because in the past I've only had one keynote session. Now I have a keynote session, some breakouts, and I'm also a moderator on some of the panels to be able to give you some more of that information that will really be able to help you in your journey and getting your business and your processes started. What is the best way to let this group know about investing opportunities? Well, we don't necessarily have an outlet for that, Janelle. So obviously you can go to, depending on the type of offering you have, hopefully you're allowed to advertise the opportunity, and you can, come to the event next week, talk to some people, network, and get the word out by meeting some people, doing some grassroots efforts, if you will. We don't really have an outlet to be able to post offerings on a public forum or anything like that currently with this group. All right, so while you guys have a tremendous track record, this is from Richard. How much do you think GPs, especially newer ones, should address the negative syndicator news that has been hitting media more recently? That's a great question, Richard. And I would say that if I was getting started in this space, I would make sure that I align myself with an active syndicator that does have a great track record of managing assets well and producing solid returns, and joining their group as a co-GP, helping them raise some money and building your track record and your credibility, so that when you go and do it on your own, you can talk to the investors about how you have been able to mitigate some of these negative things that have been happening in the news. And I think one of the challenges that we are seeing in the news right now is that something that I suspected that was going to happen is that there's a lot of gurus out there that try to bring on people that don't really have a lot of background in business experience or background and experience in business. And it's one of my other 8 red flags for real estate investing that is very important, to make sure the operator has some form of background and experience in running a business. And if you go to our website, passiveinvesting.com, and go back to it again, and you go to our knowledge center and just click on knowledge center and type in the word red flags, this will actually bring you straight over to this red flags article. Currently only has 7 in here. I do need to update here on the website, but we do have 8 red flags now. And I'll type it in here into the chat box so you have it for those of you who are joining us live. But you can go here and review these 8 red flags. And I think you'll see that if you follow some of these, that it'll follow along some of those news articles as well. This is an article that my wife and I kind of put together after we've invested with 80 plus different syndicate. We have 80 different LP positions with about 17 different operators. And so in our own due diligence and research, thankfully, we have not lost any money with our investments so far. We've had a few had to have paused distributions and delayed distributions, things like that, based on the current debt market, which is understood. But so far, our LP portfolio is in a great position, and it's because we've been following these red flags. And so I would encourage anybody who's interested in investing as an LP to review these red flags, but also those of you who are interested in being an active operator, go there, review these red flags so that you can incorporate some of these into your own business as you're continuing to build up your relationships and creating some partnerships. So thank you so much for being here. Hopefully next week you'll be able to have a great time at the MFIN Con. I do not believe we're doing one next week. Nope, we're not. So we're skipping next week, and so since we're going to have the MFIN Con coming up on Monday, Tuesday, and Wednesday of next week, look forward to seeing you there. But the next one is going to be how to use debt effectively, and this is going to be with Angela Dunn. So how to balance new capital, return of capital, and recycle capital funds. And this is specifically in regards to a debt fund. So if you've thought about or wanted to incorporate a debt fund into your particular offerings to your investors, this would be a good opportunity for you to listen in. And look forward to, again, seeing you at this webinar, but also next week in Charlotte, North Carolina at the MFIN Con. So thank you so much for being here. Look forward to seeing you next week. Go to mfincon.com to register for next week, and I hope you guys have a good rest of the day.